Art Wu, Director of Sovereigns at Fitch Ratings, joins us on the phone line. Thanks so much for joining in, Mr. Wu. So amongst the highlights of your report, one of the things mentioned is that the weak rupee will not trigger any rating action and not yet hurting India's credit rating. So when do you think, at what level for the currency do you think it will actually start materially impacting India's credit rating?
Well, it's a very difficult question because really depends on a lot of developments for the currency that we're not currently envisioning happen. And I think the key message that we wanted to get across in this report is that the emerging market sell-off that took place over the summer, over the middle of 2013, which not only hit India but a number of other countries and led to a sharp decline in the currency. It hasn't necessarily led to significant pressures that have, hurt India's sovereign credit worthiness to the point that would trigger us to consider any sort of action. So it comes back down to the basic fundamentals of the economy when we're assessing the overall economic outlook and both the balance sheets of the external side of the economy, the external finances, and the public finances.
Right, but just taking from that point that you've made, what are you keeping this view out in lieu of the fact that there could be risk for the rupee to fall further from here? I mean, if the rupee goes to 67.70, does that bring about a higher possibility of a change in your outlook?
I think a lot will depend on one, your whether that actually occurs. Two, I think you're right in your assessment to suggest that there could be further pressures on the rupee. As you know, the commencement of Fed tapering hasn't necessarily happened. And even looking beyond the issue of Fed tapering, the reality is, Fitch does believe that the U.S. will eventually begin to raise interest rates, and, our base case is maybe for that to happen in the middle of 2015. So if you look at the outlook going forward, is that, global liquidity conditions will tighten. And then that also necessitates, well, what would be the policy response of the authorities, both on the monetary and fiscal side, whether we'll see any balance sheet improvement take place. So there are a lot of factors, intermittently that could determine how the economy responds in the coming quarters.
Right. The reason I ask you that, Art, is essentially because, you had revised your outlook in the summer this time from negative to stable. S&P continues to keep its outlook at negative, given the vulnerability that there is on the currency side. So what convinces you to maintain your outlook at stable for India?
Well, I think if we circle back to when we actually revised the outlook back to stable in the middle of June this year, I mean, that revision was made on a couple of factors. One, there had been efforts to consolidate the fiscal position. So the government did meet its central government fiscal deficit target for FY13. Two, there have been measures or efforts made to, improve the reform process and improve the implementation process of investment, so that so there are efforts overall made to improve the investment climate. So those are the reasons why we made the revision to the outlook back to stable from negative. So in the current situation, given what's happened with pressures on the rupee, the main point we wanted to emphasize in this report is that there have been repercussions. It has, the pressures on the rupee have obviously, one, led to a rise in inflationary pressures, dampened consumer and business confidence. So it sort of hurt the economic recovery. But however, on the flip side, we have seen some improvements in terms of the current account. Merchandise trade data suggests that the current account should improve. So that should take some pressure off the economy, or particularly in terms of the external finances. And two, the government seems to be tackling inflation. And when I say government, I should probably specify the Reserve Bank of India. They've moved towards a tighter monetary policy stance, and also appears to be importantly signaling that they want to, they're going to focus more effort on capping consumer price inflation or retail inflation compared to WPI or wholesale price inflation in the past. So there have been some other developments that I guess you could say have been a little more on the encouraging side.
Right. Art, just tell me, if indeed, you mentioned tapering, if indeed tapering happens sooner rather than later, would it have a material impact on how fund flows go out of the Indian bond markets and therefore on the bond yields? And two, of course, also on the Indian currency, because that may have the potential to drag the rupee down sub 65 or even 70 to the dollar. You think that could happen?
Well, I mean, that's always a possibility. However, I think we also have to be mindful of the fact that, there has been a large degree of capital outflows that took place over the summer. So that may, so some of those outflows just may have left, and that probably means that, some of the, even if there is the Fed tapering does occur, we may not see the same degree of pressure. A lot also depends on, how inflation and how the interest rate environment involves. And obviously the authorities have tightened the local liquidity environment. They've raised the policy rate. So, so that may help stave off, the type of pressures that we saw take place over the middle of the year. So very difficult to say, but I mean, as you might have seen in the report, we do acknowledge that, once the commencement of Fed tapering does occur, there's a likelihood that not only India but some other countries which experience pressure on their currencies over the summer may also, see that occur again. But perhaps very difficult to say, but maybe to a lesser degree.
All right, Art, we'll leave it at that. Thanks very much for joining us.